The U.S. Securities and Exchange Commission's approval of the first spot Ethereum exchange-traded funds on July 23, 2024, marked a pivotal moment for the cryptocurrency world. This landmark decision opened the doors for wider mainstream adoption of Ethereum, the second-largest cryptocurrency by market capitalization. The approval followed the earlier green light for spot Bitcoin ETFs in January 2024, signaling a growing acceptance of cryptocurrencies by regulators and institutional investors. These ETFs offer investors a regulated and familiar way to gain exposure to Ethereum without directly owning the underlying asset. This is particularly appealing to institutional players who have been hesitant to navigate the complexities and security concerns associated with cryptocurrency exchanges. The SEC's approval of spot Ethereum ETFs is expected to have far-reaching implications for the cryptocurrency market as a whole. It marks a new chapter in the evolution of the cryptocurrency market, one that could see Ethereum playing an increasingly prominent role in the global financial system. As news of the impending ETF approvals spread, the price of ETH experienced a surge in the days leading up to the official announcement. The anticipation of increased demand from institutional investors, fueled by the accessibility of ETFs, drove a wave of optimism in the market. This surge was reminiscent of similar price movements observed in anticipation of the Bitcoin ETF approvals earlier in the year. However, the initial euphoria was met with a slight dip in ETH's price on the first day of trading for the newly approved ETFs. Nevertheless, the long-term outlook for ETH remains positive, with many analysts predicting that the ETF approvals will pave the way for sustained growth in the coming months and years. While the arrival of ETFs is undoubtedly a positive development, it's essential to remember that the cryptocurrency market is still in its early stages and subject to significant volatility. The initial price reaction to the ETF approvals serves as a reminder that investing in cryptocurrencies carries inherent risks. With the SEC's green light, a number of asset management firms rushed to launch their spot Ethereum ETFs, providing investors with a diverse range of options to choose from. These ETFs track the price of ETH, allowing investors to gain exposure to the cryptocurrency through traditional brokerage accounts. Among the approved ETFs are offerings from industry giants such as Grayscale, VanEck, Bitwise, and Fidelity, each bringing its own reputation and track record to the table. For instance, Grayscale, known for its Grayscale Bitcoin Trust, launched its Ethereum ETF with a competitive expense ratio, aiming to attract investors seeking a cost-effective way to gain exposure to ETH. Similarly, VanEck, a firm with a long history in commodity ETFs, offers its Ethereum ETF as a way for investors to diversify their portfolios with digital assets. Lower expense ratios translate into higher net returns for investors over the long run. It's important to note that the landscape of Ethereum ETFs is still evolving, and new entrants are expected to emerge in the coming months. Section 4. Strategy ETFs versus Spot ETFs. Understanding the difference. The approval of Spot Ethereum ETFs has added a new dimension to the existing landscape of Ethereum-related investment products, which previously included Ethereum Strategy ETFs. These strategy ETFs, unlike spot ETFs, do not directly track the price of ETH. Instead, they invest in Ethereum futures contracts or other derivatives, aiming to generate returns based on the performance of the underlying asset. Spot ETFs are considered less complex and more transparent, as their performance is directly tied to the price movements of ETH. One of the key advantages of spot ETFs is their lower expense ratios compared to strategy ETFs. The choice between spot and strategy ETFs ultimately depends on an individual investor's investment goals, risk tolerance, and understanding of the underlying assets and investment strategies involved. It's crucial for investors to carefully weigh the pros and cons of each option and seek professional financial advice if needed before making an investment decision. Section 5. The staking question, a waiting game for investors. While the arrival of spot Ethereum ETFs has been met with enthusiasm, one key feature is notably absent: the ability to earn staking rewards. Staking is a process that allows ETH holders to participate in the network's consensus mechanism and earn passive income in return for locking up their assets. The lack of staking rewards in spot ETFs stems from regulatory uncertainties surrounding the treatment of staking income by the SEC. The current regulatory framework does not provide clear guidelines on how staking rewards should be taxed, or whether ETF providers can legally pass on these rewards to investors. The absence of staking rewards is a significant drawback for investors seeking to maximize their returns on Ethereum investments. However, the landscape is expected to evolve as the SEC provides further clarity on the regulatory treatment of staking. Until then, investors seeking to benefit from staking will need to explore other avenues such as holding ETH directly or investing in centralized or decentralized staking platforms.